In a recent video, I made a brief mention of gift tax, which apparently piqued some interest among my subscribers, as evidenced by this comment. So I decided to tackle this subject sooner rather than later. So here it is, the gift tax, oversimplified. First of all, as I mentioned in the original video, the gift tax is a tax on the giver, not the recipient. Bona fide gifts you receive are not generally taxable income to you. Second, this video does not go into the details of calculating the gift tax or how to fill out a gift tax return. The aim of this video is to give you an understanding of what the gift tax is, why it exists, and when you might have to file a gift tax return. If you think you might need to file a gift tax return, I highly recommend you not do it yourself and seek assistance from an experienced tax professional or estate planner. So what is the gift tax, and why does it exist? The United States currently levies estate tax on the value of relatively large estates. For 2022, that's estates valued at over $12,060,000. So you might be asking yourself, can't I just avoid the estate tax by giving away my estate right before I die? To keep people from doing exactly that, the gift tax was devised. It levies the same tax on the value of the gift that would have been levied on the estate. Gift tax rates range from 18 to 40% depending on the size of the gift. This keeps people from avoiding estate tax by giving their estates away. Gift tax is levied on the value of any individual gift exceeding a threshold amount, which is $16,000 for 2022. The following types of gifts are not considered taxable, regardless of the amount of the gift. Most gifts from one spouse to another, any charitable or political contribution, and any direct payment of another person's educational or medical expenses. The key here is that the payment must not pass through the hands of the other person and instead go directly to the educational or medical institution. You might also have a taxable gift if you sell something to someone else for substantially less than its fair market value, especially if the transaction is to a person that is related to you. Example, Bill and Penny decide to sell their home to their daughter Marion and her husband Ralph. The fair market value of their home is $345,000, but they decide to sell the house to Marion and Ralph for just $150,000. The IRS considers this to be a gift of $195,000, which is potentially taxable. So what happens if you do find that you've made a taxable gift? You need to go ahead and file a gift tax return, and you'll have two choices. You can go ahead and pay tax on the value of the gift that exceeds the threshold, or you can go ahead and tell the IRS that you're electing to reduce your estate tax exemption by the taxable portion of the gift rather than pay the gift tax now. Since most people will never have an estate large enough to pay estate tax, that essentially means there is no tax on the gift. Because of this, the estate tax exemption is also referred to as the lifetime gift tax exemption, the unified credit, or the unified exclusion. Let's see how all this works. Ronald decides to give his son Robert a BMW worth $52,000 as a graduation gift. Since this gift is worth over $16,000, $36,000 of the gift is considered taxable. When Ronald files his gift tax return, he tells the IRS to reduce his lifetime gift tax exclusion by $36,000 to $12,024,000. Since he doesn't expect his estate to be that large, he avoids paying gift tax entirely on this gift. If Ronald were married, he could reduce the impact the gift has on his lifetime gift tax exclusion using a technique called gift splitting. Married couples get two $12,060,000 lifetime gift tax exclusions. Even though Ronald made the gift entirely from his own funds, his wife Raeanne could agree to split the gift. Ronald and Raeanne could each claim a $16,000 annual gift tax exclusion, leaving each spouse to exclude $10,000 each from their lifetime gift tax exclusions. In the case of Bill and Penny, they would split the gift as well, each reporting half of the $195,000 gift, or $97,500. Both halves would be subject to the $16,000 annual gift tax exclusion, and each would reduce their lifetime gift tax exclusions by $81,500. In these cases, Ronald and Raeanne and Bill and Penny would each have to file individual gift tax returns. The gift tax is an individual tax. You cannot file a joint gift tax return. And for both couples, if one spouse were to pass away, the surviving spouse would gain any lifetime gift or estate tax exclusion the other spouse didn't use, reducing the potential for both gift and estate tax. If, for example, Penny were to pass away, her remaining lifetime gift tax exclusion would be added to Bill's, increasing it to $23,957,000. And that's all most taxpayers need to know about the gift tax. This is a very oversimplified view of this topic. If you'd like to know more, I've linked some additional resources and information in the video description. Did you find this video informative? Give it a thumbs up and share it with anyone who would find it useful. If this is your first time watching one of my oversimplifications, subscribe to have new Tax Geek videos show up in your feed. And your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.